And on today's show, how to leverage life insurance in an inhospitable environment. Part 5 of this week's series on business asset protection with author and attorney Ike Devji. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to day 5. Boy,
thanks for having me back.
I'm glad to have you back, Ike. Of course, you've scared the living daylights out of everybody watching the show for the whole week. Before I can even talk to a client, I'm thinking about all the things for my own practice that you've talked about, which is about 90% of it actually relates to an advisor. He has to kind of get his own household in order, kind of get his own financial house in order. And then I would use those specimen policies as my lead in back into businesses. I'm sure I will be one of the few advisors coming out on my first interview introducing concepts like this.
I think you're right, Stephen. You know, I'm often surprised at how even advisors who sell P&C or property casualty insurance, let alone our life and financial advisors that you deal with, I think, primarily. I had a client who has a business that does between $15 and $20 million a year, and I wanted him to get some of the insurance that we were talking about, and D&O insurance was on the list, which was the subject of our last discussion. He went to his insurance advisor, his local P&C guy, and the response he got was, quote, "Oh, you don't need to worry about that. It's not available for you. That's only for CEOs of public corporations and people who serve on HOA boards." That was the advice he got from his own agent, who wasn't educated enough to know that D&O insurance is available to every business owner in most cases, depending on what their role and title is. It's a guy who has employees all over the country and is doing between $15 and $20 million a year. I think he was a candidate, but he was limited in that case by his insurance agent's own limited knowledge. I sent him to buy something, and the guy refused to sell it to him.
Well, ignorance is bliss, and he might be in the lawsuit litigation issues that you're speaking of.
Yes.
We're talking this segment that we're talking about today is, sometimes life insurance is in a very inhospitable environment. There's no doubt about that. But we're using it now as a major asset protection play. Let's talk about it. Let's introduce the concept, because most of our people think of it, oh, you mean the death benefit. No, I'm talking about the living benefit of life insurance as asset protection. And walk us through a kind of an introduction, because a lot of my life producers are watching this show today are going to go, I never knew that.
Sure. And this is the neat thing about this discussion, is that this is a tool that your viewers already have at their disposal and about which they have a huge amount of expertise. If they're smart enough to be watching your show, these are guys who already understand insurance, right? So one of the things that we're talking about is that we talk about exemption planning many times as part of asset protection. Sure, it involves the trusts and partnerships and corporations and exotic offshore things that a guy like me might do, but at its most elementary level, it includes what we call exemption planning. And the most common example of exemption planning that the general public is familiar with is homestead, right? You know that in every state, state law dictates that there's a certain amount of equity in your house that's protected for you against lawsuits and bankruptcy and other kinds of exposures depending on your state. And we get that IRAs and 401ks have inherent legal creditor protection by statute. Not because Ike or some other lawyer said so, but because the black letter law of the state and of the country in which you live says this is off limits. Well, life insurance works exactly the same way. And even most experienced insurance advisors don't make that creditor protection feature part of their conversation. In fact, more than half the states in this country protect life insurance and cash value of life insurance in particular to a, quote, unlimited dollar amount. In some states, it's day one. In other states like Arizona, there's a 24-month vesting period. But Texas, Florida, Hawaii, Illinois, New Mexico, Kansas, a whole bunch of others protect the cash value of life insurance to an unlimited dollar amount by law. It's a black letter law of the state.
No, I think a lot of people are under the assumption that I thought it was just, hey, there's a 150,000 limit, or there's this. There are limits. Some states have limitations.
Some states do, and like I said, more than half the states have unlimited creditor protection.
Unlimited creditor protection for life insurance, and some of them start day one. They're protected day one. Although you said on our state, Arizona, we have a 24-month vesting schedule.
That's correct.
Okay.
In Arizona, for instance, if you have owned a policy for 24 months contiguously, and the policy has to be set up the right way, which means a certain party is the owner, certain parties are the beneficiaries, and that's where somebody like myself, who's a lawyer, gets involved, and we work with insurance advisors, which I am not, to say, okay, if you want to take advantage of the law of state X or of Arizona, then it must be individually owned with a dependent beneficiary, right? Which is a different definition than protected. We've got to narrow it down to make sure that the policy in its structure actually complies. But in some cases, this protection is even bankruptcy remote. So it's a great topic of discussion for insurance advisors, and it's a great way to integrate with some of your clients' other advisors and bring this issue up to the client. And the reason that this has been on the forefront of my mind for the last 5 or 6 years in particular is the investment environment that we've been in, where we have, for instance, clients who are sitting on cash. There's north of 30, by some accounts, north of $30 trillion in cash in the U.S. that's sitting on the sidelines in cash that people are holding because they're afraid to be fully vested in either the securities market or the real estate market. Most successful people have some money in both, but they're holding back more money in cash out of fear on the sidelines to wait and see what happens than ever before. Now, those clients then have a few other risks that are presented. Number one, if you're sitting on cash, you are more attractive to any attorney as a lawsuit target, right? Because we are trained as attorneys to chase the deepest pocket, and the first most attractive, lowest hanging fruit asset is cash or cash equivalents.
I want to hold us right there because I want to head for the break. But I want to really break out this comparison between investments and life insurance as a living asset, and then talk about how does it make, because I do want to say who should own it, who should be the beneficiary, and who should be the policy insured. We'll be right back right after this break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, I'm talking about it, when I'm talking about the actual life insurance, some of the perks that come with this, I'm thinking of the interest rate environment's pretty bad right now. So I know my regular insurance policies, some of these high-end cash values, very liquid, low surrender charge contracts are really great for this kind of living asset protection that you're talking about. When I look at regular rates like CDs, why would I not look at that just on the rate issue alone?
You're absolutely correct. I mean, if we talk about what wealthy people, or all of us, whether you consider yourself wealthy or not, and it's funny how many affluent people I work with who don't consider themselves wealthy because they get up every day, they work hard, they run a business, they take their kids to soccer practice. I'm the first one to point out to them, I get you work hard, but you're still in the 1%, top 1%. Right. That doesn't change that for you. But we look at what those people are earning on the money they have in the bank, which in the last segment we said they're holding on to more cash than ever out of fear. What are people getting on that? Most people are getting substantially less than 1%. In many cases, it's 30 to 50 basis points on the money in the bank. And so we look at, okay, we're in an environment where people are sitting on cash, where they have ongoing concerns about the economy. They have ongoing concerns about bank solvency risk, right? We've seen hundreds and hundreds and hundreds of banks close over the last few years. We have FDIC limits on how much is protected in any one of those things. And we have more and more people looking at alternatives to cash or looking at life insurance in a very specific way, which is not in the traditional way that the life insurance salesperson looks at it, or even in which the estate planner looks at it. But I'm looking at it from my perspective as exemption planning that provides a creditor-protected alternative to cash. If you have a policy that is liquid, as you said, highly liquid, almost completely, or which will be liquid within a few years, the same kind of restrictions that you're seeing on a CD, right? If you put money in a CD, you're locked in there for 2 years, 3 years, 5 years, 10 years, depending on what kind of rate you're fishing for. What if you could have a comparable or better level of liquidity, have a multiple for economic efficiency at your death, and have creditor protection by law? Can I ask you a couple of questions,
Sure.
Steve? So, for instance, if you were in an accident and had $1 million in a CD and were sued, how much of that $1 million would be at risk to that lawsuit?
Oh, all of it.
Okay, and what about if that same $1 million was in a creditor-protected state like Texas or Arizona, and you had that $1 million in a life insurance policy? How much of it would be at risk?
It should be none of it.
Right, if the statute applies. And by the same token, if you pass away with $1 million in a CD, how much do you get back from the bank if you're lucky?
Well, maybe the original.
Get the principal back if you're lucky, and let's assume there's no estate tax exposure. What if that $1 million was in a life insurance policy and you passed away? What would the economic result be?
So we'd get it all.
You'd get it all. You'd get a multiple, right? In almost every case.
The death benefit, yes.
Yeah, you'd get the death benefit. So we're looking at these kinds of things and saying, how can this be used? Now, of course, neither I nor any other ethical and educated advisor would take every dollar that a client has and put it into a life insurance policy instead of having any cash. That's clearly not what we're saying. But what we are saying is that there are people out there who have a substantial amount of cash, and who at the bottom of that, whatever that number is for each individual, they have that bottom 10 or 20%, which they always keep in cash for opportunities and emergencies, right? That's the in case of emergency break glass number. Do you think, as an insurance expert yourself, that it might be worth and ethical to have a conversation about the economic benefit of taking that bottom 10 or 20% of their cash holding and looking at another strategy like life insurance as an alternative that provides creditor protection by law, that provides a death benefit multiplier, that has all of these other advantages, and in some cases, if they're working with somebody sharp, can be as liquid or more liquid than what they would have put in the bank?
Yeah, to me, I think this is a comparison, a yin and a yang approach that I really like. And I think most businesses have never seen the liquidity feature that you're talking about, looking at the rates better than traditional money markets and or CDs. And the biggest thing is the tax advantage, and if there is a death insurance, let's just say I don't even care about that for a moment. These alone should be enough to sell, much less the death benefit. But I want to talk to you about the expense load real quick here before we end our segment today in our show. I've noticed that if you do this right, your expenses in the policy pretty much are going to be probably even money to the cost that the return, and the expenses will be pretty much even. They'll probably cancel each other out. But that means that the client has this money, even if it does nothing, zero, but give you free insurance, basically free insurance, your money's still protected from the creditor issues depending upon your state.
That's absolutely correct. I mean, some of the best policies out there that we've seen might credit 4% a year, and the internal cost of insurance might be that equal 4%. Now, of course, we are talking in general terms, and everything's subject to specific underwriting. And you know, everybody watching has probably read enough of those little disclaimers at the bottom of every piece of paper to understand that what you and I mean. But yes, in general, if the policy is structured right and the person meets the underwriting qualifications, they can get that quote-unquote free insurance. And we know that our advisors can't ever say the F word, but that's the result. And somebody might say, well, there's an opportunity cost. Well, that's money that client was going to keep in cash anyway. And the question is, was there a greater economic benefit having that money in the bank, in a money market or a CD, and let's assume it's a money market, earning less than 1%, fully exposed to any kind of a lawsuit, and by the way, they get a 1099 on that 1% or 30 basis points, right? Or is it comparable or better to allocate that same amount of money or some portion of it to an insurance policy that has statutory creditor protection by law, that has a death benefit that will multiply if something happens to the owner or depositor, and that has a comparable rate of return? And when we lay those things out next to each other for a client, they kind of look at it and say, well, why wouldn't I do that? It makes sense. If I have the liquidity and the creditor protection and the death benefit, and oh, by the way, whatever tiny bit of growth I might be able to get, let's assume there is a few points above, a few basis points above the internal cost of insurance, well, that's tax-free, right?
Right. So much the better.
So I think that from the insurance advisor's perspective, it makes sense. From the asset protection attorney's perspective, it makes sense. And as you said, part of the issue or problem is that most consumers don't even know this is an option.
I thank you for being on our show all this week. It's been an eye-opener, I have to say. That's our show for today. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, you can catch up on all our past episodes by going out to downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. See you next week.